Welcome everyone to today's session, Mid-Year Market Update presented by our guest speaker, Matthew Coe. He is an investment strategist at Rowe Price with a CFA. And for those of you who don't know what that is, a Chartered Financial Analyst is a globally recognized professional designation awarded by the CFA Institute that focuses on advanced investment analysis and portfolio management. So if you didn't know, now you do. This webinar is hosted by Lumena Financial Strategies, and your moderator today is Allison Fleming, President of Lumena Financial Strategies. Allison is a certified financial planner practitioner, and for those of you who may be joining us for the first time, I'll go ahead and introduce her. Allison's been a financial advisor since 1989 and serves clients in 29 states across the country. She holds a bachelor's degree in speech communication from Cal State Long Beach and believes that we must always adapt to the changing environment, remain current, and take advantage of opportunities to improve our clients' lives. Our local motto, be a long-term thinker, not a short-term worrier, serves as the cornerstone of her discussions. With that, I'll go ahead and hand it over to your host, Allison.
All right. Thank you so much, Caress. I appreciate that good introduction. Before I go ahead and introduce our speaker, let me make sure that everybody here knows the team. Miles Fleming, our Executive Vice President, Insurance Specialist, specifically focused on Medicare. We have Britt Stevens, our Vice President, and Peter Fink, our Resident Stock Picker. Damian Feldman, who's our Client Experience Manager. Those of you who are our clients often will be hearing from him. He's so busy scheduling appointments right now, actually. We have Terry Jocelyn, our Executive Assistant and Administrative Manager. And then we have Maddie Uoa, who is up in our San Pedro office as Senior Administrative Assistant. And I'll just make a note that Damian and Maddie have both now gotten their notary license. And so Maddie's received her stamp and has started doing notaries. Damian has passed the test, got certified. We're just waiting for his stamp to show up. So for those of you that are local, we'll be letting you know that we can now provide that service. So back to our team, we have Kaylee Levin, who's our Client Care Coordinator. I have Lucy Adame, who is also up in our San Pedro location as Administrative Assistant. And then, of course, the voice from the sky, those people know her very well. Caress Vera, our Creative Director, who's in charge of all the webinars and has done all the artistic parts of what we're working on today. So here's our disclosure slide. And I would just like to say, there you go. You've now been fully disclosed. I would like to invite our speaker to join me, Matthew Coe. And before I turn it over to you, Matthew, and I know you like to go by Matt, I wanted to thank Rowe Price. And I know behind the scenes, we have Katrina Jacobs here in our Zoom room with us. You won't see her on camera, but she is our local contact at Rowe Price. It's one of our investment companies that we use frequently for a lot of our investments. And so Katrina was in our office and offering help on anything that we need to have help on. She brings us up to date on their investments, and she's the one that connected us with Matt. So Katrina, I just wanted to acknowledge that and thank you so much for your assistance with that. And Matt, I'd like to just turn it over to you so that you can have as much time as possible to do your thing. We're just grateful that you're here. And I will let our audience know also that Matt is here after hours because he's actually on the East Coast. And so this is getting a little bit towards dinner time and almost bedtime for him. And we appreciate you being here for us. So why don't you go ahead and take it away? I know, just bring me in whenever you need me. And if you don't need me, then I'll see you at the end.
All right. Thanks, Allison, for the intro. Thanks, everyone, for allowing me to present. It is the evening hours here. I'm actually operating out of a hotel in New York City, but I enjoy giving these types of discussions to clients to just share, not just our firm's market outlook as to where we think the markets, as well as key investment themes, are headed over the next several months, but also to really hear perhaps questions, concerns you might have regarding markets, and allowing me to provide some perspective. So for today's discussion, we're going to start with just where we're at right now in the markets. I'm going to highlight the five major themes that my firm has highlighted as having some impact into the market direction on a go-forward basis, and then end with some thoughts around what does it mean for your investment portfolios. So if we go ahead one slide to start with where we're at right now. The title at the top on the top left, resilience is not stability. I think that's something that you might want to jot down. If you think about the first half of this year, we had obviously the war with Iran that's still ongoing. We had the results that spike higher in oil prices that ultimately resulted in higher gas prices at the pump and higher inflation readings. And that was also an environment where before Iran, there was some concerns that perhaps it's AI leading to job or maybe not necessarily job losses, maybe job losses in certain parts of the labor markets, but maybe just a slowing of hiring intentions, maybe more firing intentions, especially amongst big tech companies. So there was this sort of mood within corporate America that maybe things just aren't as good as some would have wanted or expected. And the labor market was giving some signals that perhaps the economy was slowing. And there weren't really any strong conclusions. But the concerns that some had was if you're in a slowing environment and then you put a more of an inflationary environment that causes consumers to feel the pain at the pump prices as well as other services and goods that they consume on a regular basis, you might start to then tip the economy into recession. Well, that didn't occur. So we had resiliency from not just the economy and aggregate as well as consumer spending, but corporate earnings continue to do extremely well in the United States, growing almost 20% year over year. So, but keep in mind, right? Just because it's a resilient market, it's a resilient economy, it doesn't mean things are stable. If I were to give you an analogy, and I'm going to draw on what happened recently in sports, so I'm going to use like a World Cup analogy for some of you soccer fans. If you had watched the finals of the World Cup, Spain versus Argentina, if you watched the first half of that game, the first half ended in a 0-0 tie. So if you're rooting for Argentina, you would say, "Hey, we're in this game, right? Like we're somehow in this game. We have a chance." But if you were watching that game closely, what you saw was Argentina had no shots on goal. The goalie made some incredible saves in the first half, and there was not a lot of sort of coordinated offense. So, Argentina was in the game, right? If you're just looking at the score, it's a tie. But if you are more, I guess, a careful observer of watching soccer matches, you would have seen that I think Spain is doing a little more in dominating control and possession of the ball. And it only is a matter of time before they may be able to, string together some offense to create a scoring chance. And so that's how I look at the markets today. Is that yes, it's resilient. Yes, things are up and actually quite up quite well in certain parts of the markets. But the undertones of the economy, things aren't really there in terms of stability, right? We have the geopolitical conflict that's ongoing, but that's starting to push into renewed concerns around energy sources, as well as the ability to secure those sources. So this is going to cause, I think, from an investment standpoint, a lot of capital inflows into not just the oil and gas drillers, but perhaps also security and defense companies and also countries around the world thinking about it more from a strategic standpoint and building up strategic reserves of energy versus just sort of going into the marketplace in a wholesale market environment and just saying let's just buy at the lowest cost. But what does that ultimately result in, right? If there's more greater demand than there is supply, right, that could be ultimately lead to higher prices. And that's the next point, sticky inflation. What we see is here in the U.S. An economy that is still growing, is still relatively healthy, especially from a corporate earnings standpoint. But we're seeing outside the United States is that you had a fiscal spending package, so government spending package in Europe, led really by Germany, and Germany's sort of focus on infrastructure build out and rearmament. As the U.S. takes its sort of place or steps away from being the world's policeman, you have Germany sort of stepping into that void, at least as it relates to in Europe, and trying to be a little bit more focused on military spending. And the expectation is other countries may then start to pursue a similar policy on a go-forward basis. That leads to just more manufacturing activity, right? Here in the United States, in Europe, you're also seeing that manufacturing activity still being, quite strong in parts of Asia. And so this leads to, a world where inflation pressures just sort of linger, right? Start to persist. Now, why that matters? Well, 6 months ago, there was a lot of expectations from investors here in the United States that maybe we could get some rate cuts finally, right? The Fed had raised interest rates to combat inflation, especially the high inflation we had immediately after the COVID recovery. And then the thought was well, maybe interest rates are too high and we're starting at, maybe some interest rate cuts on a go forward basis. And if we can get those cuts, that would be stimulative, right? That means consumers can borrow money more cheaply. Perhaps that could be some sort of benefit for the housing market that's largely been stuck for several years now because mortgage rates are just too high and the prices of homes are relatively too high to allow for meaningful sort of growth in the housing market. But what we're seeing is the opposite, right? The economy is doing well here in the United States. The manufacturing activity is actually surging in certain parts outside the United States. And that ultimately results in just kind of lingering inflationary pressures that may force the Fed to be on pause and not give us the rate cuts that some would have hoped for. Now, what has supported risk assets, right? Meaning financial markets. I talked about the healthy growth and not just the economy and corporate earnings, but third bullet point on the right, relentless AI-related investment. This is a dominant theme. There are many who are looking at the spending of the big hyperscaler companies, the big tech companies like Google and Amazon, Microsoft, and the accountant and sort of in everyone's sort of mind in the financial industry would say, that's a lot of money, right? That's a lot of money being spent. Can we get a payback for that? Others who are a little more optimistic would say, we're at the beginnings of a transformational shift in our economy, transformational shift in sort of how we would conduct our lives on a go forward basis. So all the calculations around do we spend too much money? Can we get a payback? Is a little bit short sighted, right? This is no different than maybe the 90s and laying the fiber optic cables for the internet. And fast forward 10, 20 years, all of a sudden you have streaming media, right? So perhaps the building out of data centers and all the AI computing power that's being generated today, or the capacity to do that today, is going to lay the groundwork for whole new industries and businesses of the future. And perhaps following that would be an explosion of new jobs. So that spending trend is continuing, and it's not just a U.S.-centric story. It's something that we're seeing having benefits outside the United States as well. China is doing something similar to that of the United States and building out their own large language models, and then building out data centers and other, having a giant grab for technology infrastructure that can support the further development of AI technology. What this means, though, from the equity markets and from an investment standpoint, is that we're now starting to see market leadership broaden. It was not that long ago where we had acronyms like the Mag 7, the Magnificent Seven stocks. And those 7 stocks, typically the large big tech companies, led the markets, and a disproportionate amount of the overall market returns came from those Mag 7 stocks. But if you look at the last 6 months, what you see is that Mag 7 acronym is now starting to get a little bit too tired. Perhaps it's maybe time to retire portions of that Magnificent 7. What we're seeing the new leaders are typically smaller companies that are beneficiaries of the $1 trillion in AI capex spending. These are companies that are in technology, making semiconductor chips, but more memory versus GPUs. Some of these companies are more industrial companies in nature, providing power and cooling fans, or providing equipment to make the electrical grid that much more resilient. So now we're starting to see a broadening market participation in terms of stocks that are doing well for the year. And this tends to be a positive sign. Healthy markets are more broad-based and concentrated. But remember, too much of a good thing, right? If the market starts to do well, companies start to do better, or priced higher, right? That's good for your investment portfolios. But tying it back to inflation, what does that mean? That means the economy and the undertones of the economy are doing well. That means people are getting jobs, maybe even some raises, and that's going to ultimately lead to persistent, more lingering inflation. So that is where we're at today. The markets have been quite resilient in the face of a number of potential headwinds, but it's not all stable. There are some real risks underneath, and some of that is not going to be resolved anytime soon, such as the geopolitical concerns that we have. as well as maybe some geopolitical fragmentation that we have. And the pressures that's going to result ultimately from an inflationary standpoint is not something that we believe can be sort of addressed in a very, very short period of time. So the market is becoming that much more fragmented. It's also, from an investment standpoint, going to be that much more selective. It's less about acronyms and buying just the big 7 companies or the big 10 companies or just buying the S&P 500. We do believe there's going to be a lot more nuance to the decisions that need to be made for an investor on a go-forward basis. So let's go ahead one slide to go into the 5 themes reshaping markets. You'll see the 5 themes highlighted here. I'm not going to go through all 5. All 5 are important, but I would say they don't necessarily deserve equal amounts of time and attention. And if I were to look at all 5 themes, there are a few there's some overlaps amongst the 5 themes, at least from an investment takeaway. One is something I'd already discussed, inflation. The other one is sort of on AI moving into the real economy. I'll share some examples of what that means and how that's impacting sort of day-to-day sort of work for not just for myself, but many others who are not just experimenting, but actually deploying AI into the day-to-day work. And then the market concentration. That's something that is a real risk as it relates to the exposures an investor may have in a portfolio. Right now, if you're looking at the S&P 500 index, you would think by buying that index, you have a very diversified exposure to the large cap companies in the United States. But if we look at the weightings of the index, the top 10 stocks in the S&P 500 make up about 40% of the overall index. So one way to look at it is, I'm invested in hundreds of companies. Another way to look at it is, but only 10 stocks really matter. That concentration, we believe, is going to make for more dispersion of returns and more opportunities as that market set sort of broadens. But from investment takeaway, it is a risk sort of worth mentioning and managing for as best you can. So let's start with geopolitical fragmentation. Right? This is something that we have seen in the United States going back to President Trump's first term, and then under the Biden administration, and and here in the second term with President Trump. What we're seeing is trade with the United States and China, trade with the United States and other countries have started to decline. One statistic shows that the level of trade between the U.S. and China is down about 30% today, and that trade is now being rerouted to other areas, and mostly in developed Europe, as well as areas in Southeast Asia, and as well as Mexico and in South Asia, with India being beneficiaries. So that geopolitical fragmentation really starts with the current administration's view that China is perhaps sort of has overcapacity in certain respects with regards to manufacturing, and in order to try and control for that, they need to layer on tariffs. And so that has a massive impact in terms of relationships between not just U.S. and China, but as that trade then starts to reroute itself across the globe, you're starting to see potential risks as well as opportunities as it relates to where that sort of trade is being rerouted. But keep in mind that the world's sort of status quo and the world order was really built off of manufacturing goods in the cheapest place you could find it, right? Business textbooks and case studies were often studied about finding the cheapest cost to produce goods, sending all of your orders there, and then turning that around and shipping it just in time, right, to where it needs to belong. But no longer. We're starting to see it's less about finding it for the cheapest cost, but maybe understanding a little bit better, is the supply chain secure? Is the supply chain going to be impacted by policy changes? And perhaps we need to double up the supply chains to make it that much more resilient in the face of potential shocks on a go-forward basis. That doubling down the supply chains, maybe even reshoring some of that, right? That can be beneficial for local economy, but also can be more costly and then ultimately leads to some inflationary pressures. Now, the fragmentation with that the original trade sort of plans and the original trade ideas being sort of ripped up and being rerouted, that causes risks. right? That causes risks for countries that were prior beneficiaries that are no longer going to be beneficiaries from a manufacturing standpoint and may ultimately see their local economy slow. So what this means is that investors need to be very, very mindful and careful about, what types of exposures that they have in their investment portfolios outside the United States. It's no longer about, I own a lot of US stocks, I own international for diversification purposes. But the question needs to be sort of brought up, well, what do you own in international? Do you own everything in international, or do you want to be selective about your exposures? And with regards to being selective, right, who are those longer term beneficiaries versus maybe some shorter term beneficiaries? I think it's much too early to say, right, who those sort of structural winners are going to be. We do know that right now the policy around global manufacturing seems to be China plus one, meaning yes, still manufacture in China, albeit at a lower rate. Beneficiaries being Mexico, India, perhaps Vietnam as well. But on a go-forward basis, right, we may start to see that start to change again. The current administration has levied tariffs on goods from all those countries I mentioned, and so we might see the supply chain reroute. This means from an investment standpoint that you have to be mindful of what risks you have, and ultimately, understanding perhaps what the fair value of those investments are. It's no longer a foregone conclusion. You can just own anything international for diversification and it'll just sort of do well. But you have to be a little bit more, I think a little more analysis needs to be done around, what types of international exposures you have, what that opportunity looks like today, and ultimately what's the fair value of those investments. Now, related to geopolitical fragmentation, I had highlighted, manufacturing, and the number two is sort of related to geopolitical fragmentation, but in a slightly different manner. There is a manufacturing revival that is ongoing right now. And I alluded to some of this in terms of the healthy economy, not just in the US, but globally. What we're seeing is the trends towards reshoring here in the United States. That's bringing more manufacturing activity back into the US. As well as explosion of spending on data centers. That's going to cause more manufacturing activity here in the United States. But also, right, in Europe, you have the German infrastructure and fiscal spending plan that's starting to help surge economic activity there. And you also have parts of Asia benefiting from being beneficiaries of the AI spending trend and in terms of manufacturing activity for semiconductors. What does this all mean? Well, if there's a coordinated sort of global or a coordinated global resurgence in manufacturing, what that generally leads to is a future state where the economies in a coordinated fashion continue to grow, do well in terms of labor markets improving and as well as that leading to consumer spending. That ultimately leads to inflationary pressures. Right, the cost of goods, cost of services just sort of naturally increase in more of a accelerating economic growth environment, and that really complicates this ongoing desire for here in the United States, the current administration, wanting interest rate cuts. Right, some investors wanting interest rate cuts because interest rate cuts makes not just the cost of financing much more affordable. But it also leads to further economic growth. It can also lead to some additional, risk-taking activities on the investment standpoint. Because of the resurgence in some of the manufacturing activities and its sort of related construction spending and infrastructure build-out, our belief is that inflation is just going to sort of linger and be persistent for a lot longer than many would have wanted or hoped for. And that makes it that much more challenging from an investment standpoint to either be sort of fully risk on because the cost of financing is higher, but also on the fixed income side, right, the bond side of your portfolio. That's typically the sleep at night part of the portfolio. That's the part that's supposed to just generate income and give you safety, which bonds should still do. But even within that sort of bond investment allocation, there are different types of bonds. There are some that have very little interest rate risk, some that have much more interest rate risk. Investors use the term duration to measure the level of interest rate risk. Our concern is that if you have too much duration or interest rate risk in your fixed income portfolios, you may be subjecting yourself to a lot more risk than necessarily desired. So let's go ahead one slide. So this is a chart that helps highlight and so what's going on in the Middle East. We had this energy shock with the Strait of Hormuz being blocked, and the sort of resultant spikes in natural gas and oil. But what you see is that there's other industries that get impacted. So that it's not just a shipment of oil and gas, but fertilizers, right? Metals like aluminum, petrochemicals, and then sort of other impacts that would be felt by having a lack of fertilizer going through the Strait of Hormuz, right? Agricultural industry obviously being impacted, the cost of building vehicles and then aircraft and sort of other machinery, right? Would be that much more expensive. Appliances. So if you think about like sort of what's happening now, perhaps at some point we get a state of affairs where the U.S. and Iran, call truce, but it will probably be an uneasy truce where there will likely be sort of persistent pressures and lingering pressures around, the shipment of goods through the Strait of Hormuz. But perhaps the lesson learned is that countries and regional blocs need to build up strategic supplies of fertilizers and aluminum and petrochemicals. Should there be another global supply chain shock that ultimately increases demand for such goods, that supply isn't available. So the downstream impacts being things that you and I would consume would ultimately result in just higher inflation and higher interest rates is sort of our concern. This is something that, as we see supply chains being impacted today and the geopolitical fragmentation that we've seen in that trend for the last several years, again, there doesn't seem to be any easy answers. We could potentially get another memorandum of understanding with Iran and try to cool tensions. That would put some downward pressure on perhaps some of these items listed here. But on a longer term structural basis, I'm not quite certain that the end conclusion is that the world is that much more coordinated, going back to a unipolar world where everything revolves on the dollar in the US. Perhaps that geopolitical fragmentation ultimately results in this sort of upward bias and pressures for all the things listed here and just more persistent inflation. So let's go back a slide. Go back one. Yep. So AI moving into the real economy. Now, this is the part of the conversation where people get most excited. When I'm giving these types of discussions or meeting with clients and I talk about AI, I see a lot of eyes light up, right? Initially, AI was, I own NVIDIA and the GPUs, right, that they produce. And that's helped my investment portfolios. And it's all about the questions around, how many more GPUs can NVIDIA sell? Then it quickly morphed into, well, it's not just NVIDIA, right? Who else makes GPUs? And AMD was a second company that can produce GPUs at scale. And so that was another beneficiary. Where AI is today, though, the dollars being spent are increasing at an exponential rate. And what we're seeing is that real-time bottlenecks are starting to show up in things outside of just semiconductors. Now you have these giant data centers that need to be built. But in order to build the data centers, which are just giant warehouses with a lot of server racks and GPUs at the core of it, there needs to be a lot of electricity that is stable and powering, right, all these GPUs and computers that are inside the data centers. Well, in order to do that, we need electricians. Here in the United States, we're about 50,000 skilled electricians short to satisfy the demand from just the AI data center build up. And it's not just the data centers companies that need those skilled electricians. The manufacturers, right, the reshoring of manufacturing, that's the same sort of labor pool that the manufacturers are tapping into. Electrical utilities need skilled electricians to help fortify the electrical grids. And that is a real-time bottleneck that we're seeing. This is something that my brother-in-law informed me of. He's someone who is a skilled electrician who picked up and moved to Texas because he was going to get paid $250,000 to work at a data center. About 6 months later, another company hired him for $275,000. So he's happy. He's jumping for joy. He's someone who chose not to go to college, but was working at a trade school. And he's making $275,000 working at a data center in Texas, and he's extremely excited. Now, it's not just right like my brother-in-law's story, but if you think about AI moving into the real economy, we're seeing real-time bottlenecks on a lot of just different types of companies that provide cooling fans or cooling equipment for right, the data centers, because these computers run 24/7. They run really, really hot. We see companies that provide power supply chips that just manage power, electricity, and routing that electricity to the parts of the data centers and the GPUs that need it, and then rerouting it elsewhere. Networking equipment. We're seeing, companies that just provide gas turbines to generate electricity. There is a broader swath of industries and companies that are now benefiting. AI moving into the real economy is so great that we see it in the most recent economic statistic. Typically here in the United States, they say about 70% of the economy in any given sort of time period is led by the consumer. However, if we look at the most recent quarter, the consumer actually had a very small contribution for economic growth, and some of that may be due to the fact that inflation is high, and that caused the consumer to pull back in terms of their spending intentions, as well as maybe some of the confidence declined with the war in Iran. But offsetting the decline in the consumer spending was this jump in fixed investment, which is all the dollars being spent on AI capex, capital expenditures to build out data centers, right? To build more semiconductor chips and what have. That is what we're seeing in terms of the real economic impacts today. Is that the consumer is a little bit on the back foot, but the spending around AI infrastructure spending is now leading the economy and then helping grow the economy. Now, the question may be, right, like, have we spent too much? And why are we spending so much? What we see with AI is that it is starting to evolve from the initial application usage where, you and I may have downloaded ChatGPT and Claude and started to ask it and query it, sort of questions around, find me the best pancake recipe, or design a workout for me, right? That's actually something I use it for this morning. I'm in a hotel gym. I have a treadmill, I have a bench, and I have dumbbells that go to 50 pounds. Build a workout for me that I can do in 25 minutes or less, right? And so these are things that are really, really helpful, but they're actually pretty minor in the scale of how much computing demand and power is really required for AI models. These are rather still sort of on the lighter end of sort of usage for a lot of these AI companies in terms of sort of like the computing power that's needed to answer those questions. What we're seeing right now, the adoption of AI is moving away from not just the consumer usage, but then the additional surge in enterprise adoption, meaning big companies like a Rowe Price spending millions of dollars to have licenses with ChatGPT and Claude, and then using their models to tap into our research platform, and then to not just summarize our research or providing or creating presentations around it, but now training some of these models as if it's like a 21 or 25-year-old, right, sort of college educated sort of worker who's going to be what they call an AI agent, working in the background, doing all the research work, and then coming up with its own theses, questioning, right, whether that's valid or not, and coming up with outputs in terms of research papers. These are things that require a tremendously greater amount of computing power and demand electrical usage. And because that's occurring right now, not just at T. Rowe Price, but I'd say nearly every investment firm of scale and size, but not just within the financial services industry, healthcare, right, biotech companies and pharmaceutical companies are doing this real time to do a lot of the early stage sort of work and designing clinical trials for drugs and novel cases for existing drugs. This is happening in the legal industry, right? This is happening across large swaths of corporate America. And that explosion of enterprise adoption doesn't seem to be slowing. That explosion then leads to, right, further acceleration of AI capital spending, because the amount of computing power to have all these agents working in the background is just immense. And it's something that from our research team at T. Rowe Price, we haven't seen any signposts of that slowing. And matter of fact, what we see is perhaps, in some cases, maybe the gas pedal being sort of pressed down even further, a further acceleration of the spending trends as productivity and efficiency is that much greater. Now, what I see from my own sort of day-to-day uses is that in the past, right, I would have had to have read numbers of papers to get all the latest sort of research at T. Rowe to understand what the various analysts and portfolio managers are thinking. And then I would have to try and summarize that, right, as best I could to then present it. Today, I can go into my ChatGPT enterprise license. I can, give it access to T. Rowe Price's research platform, and then ask Chat, can you summarize our latest AI views around, right, sort of infrastructure build out, and who are some of the big industrial companies that could benefit, and some of the ones that are at risk of maybe losing market share. Now, I want you to not just summarize that, but I want you to put that into a PowerPoint presentation. It can create the presentation. It can put it in the fonts and the color schemes that T. Rowe Price approves. It can have it all ready for me to then click and send it to my legal and compliance person for them to review. The amount of work that the AI agent can do in the background is something that would probably save me several days' work. And this is something that once I've trained the agent, it can do on an ongoing basis without needing a lot of input from me, other than the fact that I sort of spot check it for accuracy, help refine its output over time, and it remembers that and gets that much better. And this is just me sort of scratching the surface. I know a number of other portfolio managers are using this to augment their research work, to help find ideas, to help sort of scour the research platform for ideas that they're looking for. It doesn't replace human decision making, but it certainly helps augment the decision making process and allows us to be that much more productive and effective. Now, as AI moves into the real economy and some of the hype and excitement is sort of built around that, right? We had the market sort of, looking at, maybe a small cohort of stocks like the Mag 7 as being the primary beneficiaries, so much so that those large companies have gotten even larger. Today, if you look at market concentration, you have the top 10 names in the index making up 40% of the top 10 names in S&P 500 make up about 40% of the index. I saw some research recently from some investment banks who had estimated that it won't be too far in the distant future where potentially the top 10 names, mostly tech, would make up about 50% of the S&P 500 index. Now, that is a very, very large sort of risk factor, because you may think, again, you're very diversified and owning, banking stocks, healthcare companies, utility companies, right? Technology included, as well as, maybe some other types of consumer companies. But in reality, it's just it's only 10 names that are really going to dictate, right, the fortunes of what happens in S&P 500 or most of the gains. And that is something that is a real risk, because if one of those names or two of those names or this AI theme starts to slow, right, you could have really, really negative results, right? And even though there's 400 other names plus that could be doing well, just those 10 names could really dictate what happens for the year. Now, this market concentration is something that is almost at an extreme. We haven't seen this level of concentration, but what we've historically seen is that once you have very, very concentrated markets, generally it leads to less concentrated markets over time. Why that is? Well, there's a number of other companies that start to have their day in the sun, that start to catch up. That the big companies get a little bit tired, right? It's they're just not able to continually sort of climb over the hurdle that gets a little bit set higher and higher, and you have a lot more easier pathway for smaller companies, medium-sized companies, right, to do better and to sort of catch up to larger companies. So for us, from an investment standpoint, we believe that some of the broadening around away from the mega cap names into some of the smaller companies that are also still economic and AI beneficiaries can be had. So let's go ahead, slide here. So this is related to the great rotation, right? The big tech names, the hyperscalers. This is Microsoft, Amazon, right? Meta, Google, right? They're going to have to just continue to grow and gain even larger and larger shares in the markets and profits in order to support their capital expenditures. But the beneficiaries of all that dollars being spent from the hyperscalers are really going to be more industrial type companies, right? The construction companies, the electrical companies, the companies that make memory chips, right? Not the really expensive GPUs, but just sort of basic memory chips, or maybe sometimes various semiconductor, not necessarily semiconductor, but also various sort of analog devices that help put out sort of readings for electrical shock and power, right? And controlling for better cooling for power management supply. those are the companies that can benefit. So we see the big tech names still doing okay, right? And then being a part of everyone's portfolio, but a lot more of the enablers around AI being the bigger beneficiary on a go-forward basis. So let's go ahead one slide and sort of coming to, and in terms of key takeaways and in terms of my prepared comments, right? I started this conversation around resiliency is not stability, right? We've absorbed a lot of different shocks, the war with Iran, right? The inflation spike, and thus far the economy has moved forward in a positive direction. Corporate earnings have moved forward in a positive direction. But keep in mind, right? Just because the markets are resilient, consumers are resilient, corporations are resilient, it doesn't mean everything is stable. There can still be shocks that can really be disruptive to the markets, and as it relates to sort of the not just corporate profits, but also to the economy in aggregate. Fragmentation, right? This is going to lead to potential risks regarding what types of exposures you want to have in international markets and what the fair value for that is. And I think the takeaway from us is you do want to keep that diversification, but you want to be selective. You want a layer of research around what types of selective exposures you have with regards to your international holdings. Being inflation aware. I think one of the comments I'd made sort of continually throughout this conversation is that there's a number of reasons why inflation just may sort of persist and linger. This isn't the 2010s when inflation was largely non-existent and you could have had a mortgage rate for 3.5%. This is an environment now where inflation is persistent. Inflation shocks may occur more badly than many would have wanted or expected. And that means that being inflation aware is that you have to be mindful of what you do with your fixed income portfolio, but also sort of your appetite for taking perhaps an interest rate risk within your fixed income portfolio. And positioning for AI's next phase, the big tech companies are still going to spend. They're still going to grow. They're still going to be a large beneficiary for this AI spending and investment cycle. But the near-term beneficiaries are now moving away from those large hyperscalers to more industrial companies, infrastructure build-out companies. And it tends to also be from a size perspective, less of the large cap companies and sometimes more small and medium-sized companies that are doing better. And that's an area that we favor and also look to have in your portfolios for diversification. So let me stop there in terms of prepared comments. I know it talked a lot about sort of the key market themes and sort of try to tie it into some of the investment takeaways. What I want to do here is take a pause, right? Check in with the group here.
Thank you so much for that great overview. I think you took a really complicated subject and honed it down to some really good key points. So thank you so much. You're great. You're a great presenter and really understandable for complicated stuff. So we appreciate that. So I have had a few things come in that maybe you can address. One of them is about a particular company that is of interest to the young ones in our world. They're talking about it a lot. It's AI chip company Micron that has been going, woo, really up and down, really. But I know that company because we were with Waddell and Reed prior to joining LPL, and I happen to know Zach Shafran pretty well, and he was in Micron 100 years ago. He's now since retired. But what do you think about companies like that are really up and down and obviously influencing the market and influencing the industry? And I know they're really into the AI things, So can you address that type of thing a little bit?
Yeah, so pre-AI, right, before AI was in sort of everyone's sort of normal vocabulary, memory companies like a Micron, they were largely viewed as commodity companies that would ultimately, have a cycle where there was, maybe more upgrades for, cell phones or devices and just sort of electronics and memory chips being needed for a lot of these mobile devices. You would have these cycles where it would sort of go up in price, go down in price, and that sort of boom and bust scenario ultimately led to a very, very cyclical industry, cyclical profits. Micron was something that if you owned it for a long period of time, you made money, but in between there was a lot of highs and lower lows. But that said, the lows were always a little bit higher than the last low. So meaning sort of like it's going up and to the right, but it's also like up and down, and but still moving up and to the right. What we're seeing right now with this explosion for AI demand is that there is a real bottleneck for manufacturing HBM, so high bandwidth memory. And that's something that Micron and others and South Korean companies specialize in. And the ability to meet that demand is highly unlikely, at least for the next maybe year plus. And so what you had was this explosion once the markets realized there's a bottleneck around memory, like stock prices for companies like Micron in 6 months, sort of went up, right, 2-3x, and there's a lot of excitement over it. Our view is that yes, you're in this environment where the bottleneck won't be alleviated anytime soon, and so you're probably still in an environment where that setup for Micron is positive. However, keep in mind this is still a very cyclical industry, right? Micron is not NVIDIA. Micron can make those memory chips, but so can anyone else as long as they have the ability to bring on capacity. It's not that specialized. So now that's a general comment, right? Of it not being specialized. I think having a Micron makes sense. Having other memory exposures makes sense for the time being. But this isn't something where you can just kind of own it for the long term and just kind of sleep your head at night. There will be a time when the capacity starts to come on, pricing decreases, and immediately the stocks go down. And you're starting to see some of that right now. Samsung, SK Hynix, the two Korean competitors had really, really good results, and the stocks are down in correction. You're also seeing a lot of Micron also sell off, right? So some of the weakness is maybe a little bit of sort of blowing off the excesses around memory. The research platform T. Rowe seems to be supportive, so it's not about get in today, but sort of pick and choose when you sort of maybe build that position again and still have that exposure. But again, the Micron is not a stock that I could just own for 10 years and just sort of sleep at night, because I know somewhere in that 10-year period we'll wake up and say, oh yeah, the Korean guys are now putting in 50% more capacity, pricing is fallen, and Micron is now going to retrace all of its gains or most of its gains. So that's something that sort of balance out what types of exposures you have, what your risk appetite is, and also just being mindful that this isn't a long-term trade, maybe a shorter-term trade.
Interesting. Okay. So is this 90s? Are we in a bubble? What the heck is going on? I remember the 90s. My hair was a lot bigger then. Oh my gosh. I read this morning, this year is the 40th anniversary of Ferris Bueller's Day Off. Which made me think also, this is the 40th high school reunion for me if I chose to go. Wow. How can that be true? Anyway, it's not the 90s, it's not the 80s. What is going on?
Well, Allison, you bring up Ferris Bueller. Maybe post this call, we need to jump into a convertible and just kind of go, take a spin around town. So is this the 90s? There's certainly some bubble-like behavior. There's definitely some companies that are being priced as if it's the next AI winner, and the valuations are very, very high or extremely high in certain respects. I'm sort of benefiting from this larger trend around AI. Why it's different though from the 90s is that some of the biggest companies that have been the beneficiaries of sort of the AI trade are also some of the most profitable businesses that we've ever seen in sort of American history, or maybe in entire financial markets, right? So if you look at the profitability of Google or Meta, Microsoft, right? Like we didn't have that level of profits and cash flows for any company really in the 90s. So there is a part where you would say, oh, wow, the stock price has gone up a lot, so it's like the 90s. You'd say, yeah, but a lot of that was justified, right? Meta is able to target you and me with more precise and better digital ads, because their AI sort of model allows it to do that, right? They can feed it with more information, refine it, and ultimately push better targeted ads that allows them to have more profits and generate more profits. So this is something where the fundamentals do certainly warrant some of the performance we've seen in some of these tech names. But there's others that are sort of riding off of the coattails, right? They're saying, hey, we could be the next big AI darling.
Mm.
We're going to potentially have the next best AI model, or we're going to have some innovation around powering data centers, right? And then you're starting to see some of those stocks trade very, very high, even though they don't have the level of profits. And so
Mm.
you are getting some level, some of that bubble-like behavior. I don't want to sort of throw out any individual companies or tickers, but I would say there are pockets within the markets where you have some of that bubble-like behavior. But I'd say, when you're at the beginnings of any technological sort of innovate or not technological, but some when you're at the beginnings of any transformational technology, right? You probably get some of that, right? You get the companies that are at the forefront, and you get others who are like, the Me Too's who say, oh, I should also get
Mhm.
a similar valuation because I can be just as good. So
Yeah.
we're seeing some of that behavior, and again, you just have to be mindful and
Interesting.
selective of how you get that exposure. Maybe a good time to think about active management, right? Being a beneficiary in terms of giving you those selective exposures that you really want to have in your portfolio.
Yeah, that was going to be my next comment is that I've been around long enough to have seen the index funds versus the active managers, and I really, really, truly believe that the active managers win at the end of the day, because it's equally important to avoid the bad things as it is to just ride it all when it's going up, so.
That I'll say that I'm nodding my head. I'm agreeing with you. There's, the a research report an analyst had shared with me earlier this week, where if we look at the highest beta stocks, so these are like the most riskiest stocks, compare that to the lowest beta stocks. This market has really been driven by the highest beta stocks and the highest quality stocks. So these are companies that are profitable, have very little leverage or borrowings on the balance sheet. Those companies, the high quality companies, have been some of the worst performers in the market, which is sort of shocking. So like this
Yeah,
market has become
interesting.
this trade of high risk, low quality. Like that tends to not persist for very long periods of time. So now that's just observing the markets from a what they call like a factor lens, right? Like looking at from risk factors. It doesn't tell you anything about which types of companies are being picked up there, but it's just showing that in aggregate you're getting a lot of risk in the markets today, and not a lot of quality. And that's something that, is another one of those sort of like you mentioned earlier, is this the 90s, right? Is this bubble like behavior? We're seeing that in certain respects, in certain pockets, yes. So much so that it's showing up in those risk reports.
Yeah. Well, it's terrifying, but yet speaks to why you guys need to exist and why we need to rely on you to help us with the underlying, what's under the hood. So that's one of the things that we always do, and Katrina's helped us a lot with this, is that we look at the investment portfolios of what we pick for our clients on a regular basis. In fact, I have my investment policy committee meeting tomorrow with my team, and we always look at everything that we have and making sure that to the best of our ability, we're, matching clients with the right mix of funds. And then we don't pick the individual stocks. We let you guys do that because you are much better equipped to do that than we are for the most part.
Well,
So
I
thank you.
think what we try to do is, again, leaning on a research platform, trying to do the analysis, and also just being mindful that maybe we're not going to get all of the market's gains. We're not going to provide all of the market's gains in this sort of environment, because we know that most of those gains are coming from things that may be more short-lived or maybe a lot more riskier. And so, if you've been in this business long enough, you've been investing long enough, you all know, this mean reversion, sort of cycles come to an end.
Mhm.
And so, a little bit of leaning against the wind and maybe looking for those sort of quality companies that haven't kept up as much, but could be beneficiaries, whether it's a down market or maybe it's just part of an underappreciated sort of beneficiary of AI that no one is really rewarding today. A good example of that would be healthcare. You
Mhm.
have companies who have, AbbVie has a giant team of just AI specialists there, and they're actually developing clinical trials for drugs by training AI models and saying, hey, here's all our clinical research. Read it, understand it, see
Yeah.
what of our drugs like that worked and which ones didn't work. Then that model can come out and say, we should design a trial for this. And
Yep.
here are the different sort of things that we have right within our product lineup that could potentially right solve for this unmet need.
Mhm.
That is no different than hiring right teams of like
Mhm.
scientists from the leading institutions right to
Yeah.
do that research. But now you're doing that right in an AI sort of world. Maybe it leads to the next $1 billion drug. It's too early to say, But I would say that, there's a lot within T. Rowe Price and the halls of T. Rowe Price who are looking at the healthcare industry. It's like, hey, this could be a big beneficiary. The market says, I don't know, Matt, right? Too hard, right? Maybe it works, maybe it doesn't, but we need more memory chips today, so we're going to reward the memory chips. So, and then it's just coming full circle, right? It's just to keep in mind that cycle will come to an end. The next leg, though, is going to be maybe something more durable.
Yeah, excellent. Well, thank you again for your time. We're coming up on the end of our time together. So if anybody comes up with a question that they would like to pass along later, just email us. Our next month, we are going to be taking a break from doing our monthly webinars because we have our focus conference, which is the monthly conference, or the annual conference rather, that LPL offers to all advisors across the country. So I take our entire team to the LPL focus conference, and we do professional development for 3 or 4 days and continued learning. So in August, we are skipping our webinar. And then Wednesday, September 23rd, we're going to be back again. And just a sneak peek that it will be Miles from our team presenting on Medicare again, because it's that time of year for anybody that is in Medicare that is open enrollment and time to take another look at your plan if you're interested in doing that. So he's going to be presenting in September again for that topic, which many of you on the call probably are interested in knowing about. So with that, I would like to thank you for joining us. And again, Matt and Katrina, thank you so much for your support and for your participation in this. We really appreciate it. You can email us, you can see us online, you can give us a call. And otherwise, I will look forward to seeing you next time. Thank you so much. Have a great evening.